any good financial advisor will say to you, you should have 6 months of your expenses set aside in a savings account or an investment account, in my eyes, or a home equity line of credit. You can have that $50,000 sitting there available to you, that if something happens in life where you get sidetracked and you're not working like you normally would, not earning what you normally would, you can dip into the home equity line. As I said, there's a home equity loan and there's a home equity line. Our home equity line, you have two options. You can do a principal and interest payment on your home equity line, or you can do an interest-only payment on your home equity line of credit, which I love that idea. I think it's just fantastic to do an interest-only payment. If you want to keep your payment controlled and just throw extra at the principal balance as you're going along, it's a really great way to advance your equity. I'll go back to what I said about the 85%, lending the 85%. We never want to lend the maximum, especially if you intend to sell the house, and here's why. Same example, your house is worth $500,000, you owe $300,000, you're going to get a line of credit for $125,000. That leaves you $75,000, right? 85% leaves you $75,000. You pay commissions when you sell the house. You pay closing costs when you sell the house. To negotiate with the buyer of your house. Maybe the buyer doesn't want to pay you $500,000. Maybe they want to pay you $489,000. So you have $75,000. Imagine if you maxed it out and you went all the way up to 100%, then you wouldn't have any room to negotiate on the sale of your home. So borrowing 85% is genius. The other great thing about home equity lines that no one really knows, they're free. Most oftentimes they are free. There are no closing costs on a home equity line. So everyone always calls me and says, Jerry, tell me the pros and the cons of a home equity line and a home equity loan or a cash out refi on a traditional mortgage. So on a mortgage, most oftentimes there are closing costs. On a home equity loan and a home equity line, there are not. On a mortgage, the interest rate is typically lower. And on a home equity loan or a home equity line, also called a HELOC. So you get here where you get a better rate, you have closing costs, and then here you have no closing costs, but the rate is higher. So there are pros and cons to doing both. What we see the pattern that most consumers do, if they are staying in a home long term, they will buy the house and get a traditional mortgage, then be in the home for a while, and following the same example, take out a line of credit for $125,000. Then they see that interest rates have improved. They then will come back and refinance and combine the two into one new traditional mortgage. That is the pattern we see over and over and over again. They get the traditional mortgage and they tie on a home equity line to it, and they see rates have improved across the board for both, and they just put them back together so they can have one payment. That happens all the time. Very common. Home equity lines of credit or home equity loans can be used for a myriad of things. If your interest rate on your home equity line of credit is better than what you could get on a car loan, you could, in theory, go out and pay cash for a car with your home equity line and just pay yourself back on the line of credit, have paid cash for the car. Any really big expenses, college education, debt consolidation, very expensive travel. If you want to take a month and travel Europe and go and see the sights and sounds of what Europe has to offer, you can pay for those trips on your home equity line. Debt consolidation, I would say, is probably the most common thing that we see, and home improvement. Those are the two very, very common things that we see home equity lines being used for. A lot of people don't know this, but you can actually, if you don't have a loan on your house, you can take out a home equity line of credit in first lien position and just have that as the lien on your house. You don't have to have a traditional mortgage. So If you just own your house and you want to be able to tap into your equity, I would say you can do that. Certainly, same math applies up to 85%. Now, here's the kicker. If you're someone who is out in the market and you love the house that you live in right now, you don't want to sell it. You want to hold on to it because you feel like it's going to keep gaining in value. But you're going to turn it into a rental. The moment you turn it into a rental, you lose access to that equity when it becomes an investment property. If there are very few banks that will give you a line of credit on a home equity loan on an investment property, but those terms are much worse. The loan to value is much lower. They only will lend you up to say 60% of what the house is worth. So I tell everybody, before you take your current primary residence and turn it into a rental, go apply for your home equity line and get that put in place. And then you can do whatever you want to once you close. If you live in it now as your primary, and then 5 months from now you're going to turn it into a rental property, you still have the line of credit available to you, even if you don't use it. And at better terms, better rate, better loan to value. So home equity lines, I just think, are such a phenomenal tool. Another thing that you can do is that a lot of people, let's just keep using the same example. $500,000 house, $300,000 loan, $125,000 available to them. Say they want to go out and buy a $700,000. If I give you a $125,000 line of credit, you could put $70,000 down on the $700,000 house. You can use $25,000 towards closing costs. So now we're up to $95,000. And then you can leave yourself $30,000. If you're worried that you're going to have to make 2 mortgage payments, you can pay yourself through the home equity line. So you're not missing any money out of pocket. It's just, you can literally write your mortgage payment, your home equity payment from the home equity itself and have $30,000. So you're not really out, your household is not out. If you're on a budget, you're not, you can keep some of that money set aside until your house sells, and you can just pay your mortgage payment on a home equity line. So there are so many creative tools that you can use a home equity line of credit or a home equity loan for.